This is November 2017, time for another edition of the Zacks Ultimate Strategy Session, one of your benefits as a Zacks Ultimate member. This month, we'll see if Sheraz Mian and Kevin Cook can agree to disagree on stock valuations and whether they matter like they used to. Sheraz and Kevin will also conduct a portfolio makeover. There's Zacks mailbag, top stock picks, and more, as always. But first, Brian, Bolan, and David Bartosiak lead with their fundamental and technical market views.
I'm Brian Bolan. I'm the aggressive growth stock strategist here at Zacks, and I am here to go over the fundamental outlook for the stock market. First thing I want to do is take a look at how things have progressed year to date. And we can see from this chart here that the stock market, and this is the S&P 500, is up about 15% year to date, and that's through November 2nd. That's quite a strong move here when a lot of people were calling for the market to kind of stay in a trading range. I've always been bullish for the most part, and let's take a look at one of the key driving factors as to why this market is still poised to move higher. This chart here is the consumer confidence, and I know this is over the last 7 years or so on this chart, but we can see that consumer confidence has steadily moved higher over the last several years. Over the last year or so, we've seen consumer confidence move a little bit lower, but very recently we've had a reading here that shows that consumers overall are very confident about this market, and that is the basis for why I believe the stock market's going to continue to move higher. My next chart here is oil, and the general idea here, what I like to say about oil, is that it is the grease that moves the economic engine of the world. When we see oil prices moving dramatically lower, that is a basic indication that demand is lower for goods and services around the world. As oil prices move a little bit higher, that tells me things are pretty good. We can see that oil has moved from the mid 50s to the low 40s over the first 6 months or so of the year. But since that time, we have seen an excellent recovery in the price of oil. Nothing that would really worry you so much about the oil slowing things down because the price would be too high. But this is a good indication that things are looking good in the broader market. Next slide that I'm going to talk about here is housing starts. And again, this is another long-term view where you see housing starts moving much higher. But over the last few months, they had been moving lower. Things are still okay here. Recent indications here with the tax plan and how taxes might change have hurt the home builders of late. But at the end of the day, I still think housing remains pretty strong. The next thing that I want to bring up here, and this is another big macro idea type picture here, is new car sales. Now, again, we can see from the very wide angle here from 2010, new car sales continue to move higher, although throughout most of this year, this number was moving lower. But now in the last few months here, we have seen a very big pickup in new car sales. All these things, along with very strong earnings, especially from the tech names over the last couple weeks, tell me that the fundamental outlook for the market is much higher. I remain bullish.
What's up, everybody? Here with your technical overview on the markets. I am David Bartosiak, live from Sunrise, Florida. Let's go ahead and dig in the charts here, see what we have. First, I've got the S&P 500 here for you. So obviously, this is probably the most widely followed index out there. What I want to look at here is basically just the trend, the strong trend that we've seen since the lows following, or well, just before Election Day, really. Periodically, I've drawn fib levels from here to here. They get broken. From here to here, they get broken. And really, it just keeps on trucking. So if you're looking for some resistance levels to the downside here, in case the market starts to sell off, the obvious is going to be the 50-day moving average. That's down at 25.19 right now. For the most part, you've seen when the S&P 500 does get below that 50-day, it's not below there for long, okay? And the last time we traded down there was in the middle of August, with it kind of chopping back and forth there for a little bit. So overall, a very bullish sign here for the S&P 500 as it continues to make new highs, and you have the 50-day moving average that is positively sloped. Now, getting back to the charts here, I want to take a look at the NASDAQ composite here. So the NASDAQ is a tech-heavy index, obviously, and we've seen a lot of big names from tech have great quarters. So here I do have some fib levels I drew from the last time the NASDAQ got into the 50-day moving average up until a recent high where we pulled back. And if you notice there, got this move up to sort of 66.42, comes back to the 38.2% fib retracement. And then on the other side of that, you've got these fib extension levels. So rather than coming down in this direction, it goes up in that direction, and that's what you could use to get short-term targets. Here for the NASDAQ, I've got 67.93 as a short-term target to the upside for the NASDAQ. And should the market sell off a little bit, you can use this swing high right around 66.42 as your next level of support. That's all I got for you here for our quick technical overview for the market. Enjoy the rest of the Zacks Ultimate Strategy session.
Still ahead, Sheraz Mian and Kevin Cook agree to disagree. But first, this list of recent Zacks Ultimate top movers.
Welcome to the most popular segment of the Zacks Ultimate Strategy session, Agree to Disagree. I'm joined by Sheraz Mian, our Director of Research, and our topic is, this time is different, and I will argue in the affirmative. Listen, we are not in a bubble like we were in 2000 or 2007, and we're not headed to one as far as I can see. I'll tell you what's different and why after I dispel two myths. Myth number one, quantitative easing drove the last 1,000 points in the S&P 500. Remember, we broke out above the old highs of 1575. Now we're pushing on 2,600. Hey, low interest rates helped, and there being no other alternative also helped. But this is all about earnings growth. Earnings growth dominates what we're seeing now in stocks. Now, the second myth I have to dispel is that the Trump election drove the S&P to break out above 2150. That's also not true because the S&P made new highs in the summer of 2016 before the election. So, yes, the Trump administration is bringing optimism with the possibility of deregulation and tax reform, but earnings growth still dominates. Okay, so what's different? I say that we are in a technology innovation supercycle. And you see it in the earnings, you see it in the sales growth, but you don't see it in the productivity numbers that come from the government or in wage growth. All right, so let's look at some of this growth that I'm talking about. Sales growth for Amazon. This is trailing 12-month revenues. Look at this moonshot of sales growth for Amazon. Now, maybe that's just Amazon taking over every business, but do we see this kind of trajectory in any other companies? Sure. PayPal. Look at that. Just, you know, here's a technology-based payments company that's doing fantastic. NVIDIA, high-tech, computer chips for the cloud, for AI, for autonomous vehicles, for gaming, for cryptocurrency mining. Tesla, hey, they're not profitable, but look at this revenue growth. You know, they're selling more cars, and this revenue growth is expected to nearly double as soon as they get the Model 3 ramped up, when they get production ramped up. So this is the kind of growth I'm talking about. So why don't we see this in the productivity numbers? I'm going to borrow from Brian Westbury, the chief economist over at First Trust, and he sort of helped me break this down because, you know, productivity is all about, you know, the change in output over the change in inputs. But the government productivity numbers, they include, you know, it's 40% the government. So 20% federal, 20% state and local. There's no productivity growth there. So while you have productivity growth in the cloud, mobile, fracking in the energy patch, biotech, 3D printing, 3D printed parts go in Boeing aircraft and small manufacturers getting more efficiency. So it's all about efficiency. So you're seeing productivity growth of 3, 4, 5% in lots of different industries that don't come out in the government's productivity number. So I talked about those industries. I have one more I want to share with you, but I'm going to give the floor to Sheraz right now.
I don't disagree with your thesis that there are areas in the market or in the broader corporate sector where growth and productivity are really above trend levels, and that perhaps justifies those stocks to be up wherever they are. But I will push back a little bit on your notion that QE had no role or had a very small role. QE has been instrumental in keeping interest rates low. And when you look at any asset valuation framework, we are talking about stocks, so let's stick to stocks. The textbook valuation metric is this discounted cash flow model where you forecast cash flows into eternity, and that stays on your numerator. And then on your denominator is some version of interest rates. Mm-hmm. Now, it's no surprise that if you keep compressing that interest rate as what the Fed has been doing, and not just the Fed, every central bank that matters in the world is doing, lower the interest rate or the discount rate in this valuation framework, and the only result is the higher output, meaning higher stock prices or any other. You mentioned lack of alternatives that one could argue is also a function of lower interest rates. If you artificially keep interest rates low, then there is no alternative because you killed all the alternatives. So there is a fair amount of truth in these newer, fancier, more glamorous niches in the market, driving a whole bunch of stuff. But I'm consciously using niches. It's a small area. So Amazon is doing great, but you should show us the revenue chart for Macy's too. The broader retail sector, it won't be looking that pretty. Tesla is doing very good. And in fairness, the Fords and the GMs of the world are doing pretty good too. But Tesla is selling tulips, perhaps, or whatever they are selling. I don't even know. I know they're selling a very beautiful car. Just to summarize, there may be elements of some parts that are different, but it never actually is. Let me just quickly show a slide. It's not as fancy as what you are showing, but what we are showing here is the S&P 500 index versus the Russell 2000 index. And I'm not
the Russell's in red, okay.
The Russell is in red, the S&P is in blue, and it's a 20-year period. You could see that those lightly shaded areas show the last two recessions.
This is forward 12-month PE?
This is the forward 12-month PE over the last 20 years. And the S&P 500 has never been this high till perhaps around 2002. The Russell 2000 has never been this high, period. Now, I always have trouble with people using these metrics as mechanically. That this is 18.7 times versus what it was in 2002, so you should dump the market, or it's 20.7 times, it's 27.7 times for the Russell to dump the market. No, the conditions we have are specific to the conditions we have now. You can't compare the S&P 500 18.7 times to the S&P 500 in 2002. I don't even remember now.
Or this potential bubble to 2000 or 2007.
Exactly. Yeah.
So, so two more points here. Why I call it a technology innovation supercycle. Facebook. I didn't show you Facebook's revenue growth. We know it's fantastic.
That's right.
It's a media company, right?
That's right.
But it capitalizes on technology. Alibaba. Also fantastic revenue growth and why I own it. it's not a technology company. It's a retail company that capitalizes on technology. So they're like Amazon. They have cloud services. They have Alipay. They're going into financial services. So this is how technology reinvents businesses. And so nobody expected this kind of growth from these companies. It's just taking off. I promised another industry, AR and VR. I just read a report from Bank of America. Augmented reality, artificial reality, virtual reality, $5 billion in revenues they attributed to 2016. They say that's going to grow by 32 times to 2020. $165 billion industry in 2020. My last industry, blockchain. Blockchain is going to change banking, and we've already seen it because JP Morgan launched Quorum, which we talked about. So based on the Ethereum cryptocurrency, not Bitcoin, as we know. So this is how technology is changing the game, and why we're not near a bubble, and technology innovation is going to keep fueling earnings growth.
My issue on these valuation questions and then these things about this time is different, is that you have to be able to look at the valuation questions or the question about any asset price's value relative to the period you are in. So 18.7 times for the S&P 500 now, maybe it looks richer to many people compared to when they look at it the last 10 years, 15 years or anything. But when you keep it into account where interest rates are expected to be, the earnings outlook that you referred to, and these technological changes, then you have to adjust your appropriate valuation metric as well.
Fair enough. Thanks for joining us.
Before we get to the Zacks mailbag, here's a list of recent Zacks Ultimate new additions. Now, Zacks Mailbag with Sheraz and Tracey.
Hi, this is Sheraz Mian with the Zacks Mailbag for this Ultimate Strategy session. I've picked 4 questions from ZU customers, all related to the Zacks rank. So let me bring them up. The first one is from Mary. Mary's asking, I follow the Zacks rank daily. Most of the time, it is very helpful. I recently sold my holding in Amazon because Zacks had it a 5-strong sell. Obviously, with the latest earnings report, there was a very costly mistake. It has now become a Zacks rank number 2 buy. Why was this information so wrong? Mary, the Zacks rank is basically looking at trends in annual estimate revisions. Amazon's estimate ahead of this earnings release were coming down, and that's why it fell to a 4 or 5. That's consistent across the board with all the companies. The rank will be looking at what the analysts covering the stock are doing to their annual estimates. If they are coming down in a certain way, as you know, we have the magnitude agreement, upside and surprise components in the Zacks rank. If those stars are aligned one way or the other, that's what the rank will show. The rank doesn't know what the company will do in the next earnings release. There is a history. If a company has been consistently coming out with positive surprises, the hope is it'll do that in the coming quarters too, but it's not a given. As a general rule of thumb, though, we tell people that the Zacks rank is absolutely correct 55% of the time, so there's always those chances when the rank will miss it. Let's go to the next question. In fact, 2 questions on this slide. Louise is asking, I've just been wondering why Ultra Clean fell and Zacks moving it to a hold. Hold is not a bad rank, Louise. The way we have the Zacks rank number 1 and number 2, If you look at the entire universe of stocks having just 100 stocks in them, our model will create a bell-shaped curve every day for those 100 stocks and assign the top 5% of the top rank, which is the Zacks rank number 1, to the companies that have the best estimate revision strength. The bottom 5% will be the companies that have the worst estimate revision strength. Those 5% are Zacks rank number 1. The bottom 5% are Zacks rank number 5. A stock will fall to a 2 even if nothing's happening to its estimates, because the space at the top where only the 5% of the stocks could be, it's a very coveted real estate, and other companies may have better estimate revisions, and they will take the slot of a company. If you raise or lower a stock between, why you raise or lower a stock between ranks 1 and 2, why? Bill Greenberg had a long question. Part of the question he asked was that if a company announces that its CFO is changing, there is some other corporate announcement, does that have a bearing on the Zacks rank? Bill, there's no connection between the Zacks rank and any non-earnings related development. As I've mentioned in response to the other questions, the Zacks rank is responding to estimate revision strength, the annual estimate revision strength. So in the specific case of the example you were asking, that there is an announcement about a CFO changing or anything like that, if it has an earnings implication and the analysts covering the stock will raise or lower their estimates as a result of this leadership change, then that will have a bearing on the Zacks rank. Other than that, we don't really care what the headlines are. The headlines have an earnings impact, then it will show up in the Zacks rank. Coming to the last question, if I can bring it up. Okay, Trent Sherrill ask, why do the Zacks services trade a lot of number 3 ranked stocks? And your ads always tout investing is Zacks rank number 1. As a member with access to everything, there should be an easy way to review each rank group 1 through 3. Trent, an excellent question. Zacks rank number 3 stocks are not bad. We don't advise our customers to get rid of Zacks rank number 3 stocks. The key advice from our perspective is that you get rid of Zacks rank number 4s and 5s. When you buy a stock when it was a 1 or a 2 and eventually it falls to a number 3, it's no negative mark on that stock. The only reason why a stock falls to a number 3 is, as I mentioned in response to one of the earlier questions, that the top 20% of the universe of stocks that we rank on a daily basis will be assigned a rank 1 or rank 2. So a rank 3 essentially means that there is no directional thrust in the estimate revisions for this stock. Other stocks have better estimate revisions or worse estimate revisions. When they are worse, they fall to a 4 or 5. If they are better than this stock, they will go to a rank 1 or 2. Many times a stock will fall to a 3, but in a couple of weeks may again go back to a 2 or a 1. So if you look at any of our Zacks portfolios, it may have a lot of Zacks rank number 3s. The most likely scenario is the 100% chance, in my judgment, that most of those stocks entered those portfolios when they were rank 1 or 2, but over time fell to a number 3. But your instinct is correct. We tout and we advocate that you guys should be preferring 1s and 2s when you are starting a position, but don't get rid of them when they fall to a number 3.
Welcome to the Zacks mailbag. We got a lot of great questions this month. Thanks for sending them in. I couldn't get to all of them, so I picked out this one that I thought would have the most impact on many of you. So let's check out what it is. So Bob sent in this question. regarding everything basically happening in Washington, D.C. So we had the indictments in the Mueller investigation, and then he lists out other things that could be potential setbacks, including disappointing tax plan, a nuclear confrontation with North Korea, no action on an improved Affordable Care Act, more on the Mueller investigation, and then just additional fallout involving any firings or resignations of cabinet people. And so he wanted to know, how could he get ready for any of these events, and what could we do with our stock portfolio and all of that if some of these events actually do occur? So I thought, you know, what is the difference between now and what happened with Bill Clinton in the late 1990s? Everyone knows the stock market soared then, and there was an actual impeachment trial. But I went back to look, and here's what I saw when I actually investigated further. So there actually was a sell-off during the Clinton impeachment uncertainty, and as you can see, it actually fell 19.4%, the S&P 500 there. And then it hit a low just as the Senate was starting like its trial, and then it recovered most of the decline by the time he was acquitted and made new highs by the end of the year. So all of this happened within just a few short months. In there, you also had this long-term capital crisis right at near the bottom. How much were they impacted together? They probably were put in there because the long-term capital crisis was a big deal. Central banks had to come and bail out that hedge fund for billions of dollars. So that spooked the markets too. But as you can see, it did recover. But this chart reminds me of what happened during the Brexit, where we had the big sell-off, everyone panicked, and then it resumed and went up again almost within a day. But even if that had taken, you know, a couple of weeks' time, it did resume the bullish trajectory. So my advice is that you got to stay the course, even when there's these uncertainties going on out there. Unless you are a really short-term trader, you don't want to be in and out of your positions just based on what's going on in D.C. because as we've seen already, nothing is responding to what's going on out there. So stay the course. Be sure you're watching the fundamentals of your companies, and the D.C. thing will kind of work itself out. And if that scares you too much, then you maybe should rethink whether or not you should be into stocks. We'll have more every month as more stuff on this continues to go on, but we'll definitely be watching and monitoring everything here.
Sheraz and Kevin conduct a portfolio makeover right after these interesting insights from Zacks Ultimate Editors.
Hi, this is Sheraz Mian for another episode of the Portfolio Makeover segment. Kevin Cook, our senior stock strategist, is with me here. The purpose, as we always explain in these segments, is to give you an idea by discussing your submissions on points that have broader relevance across our customer base. This is a very popular segment, at least in terms of the number of submissions. It's literally hundreds of them, and it's not easy to pick a portfolio. The one we picked this time is from Kevin D. The main reason why we picked is that Kevin is the most popular name within Zacks right now. And I had Kevin Cooker with me as well. Kevin Mattress is our new boss.
I thought it was because he named it his dubious portfolio.
I was going to come to that. You're stealing my thunder.
Sorry.
Kevin D. raised a question, named his portfolio my dubious portfolio. He said the portfolio is doing very good. But what happens to it if the market turns south? And we thought it's a good enough question. And then obviously the Kevin part. So what do you think, Kevin, about Kevin's portfolio?
Well, you know, I want to say to start off, you know, we get all these submissions, and you know, we're not giving individual advice. We're just trying to look at something and give an example. And we don't know people's risk tolerance.
Yes.
We don't know their time horizon, so we really can't, dive into the specifics of their situation. But still, we picked a diverse portfolio here, under 20 stocks, and it'll give us a good look at what might happen during a correction, which is what Kevin D. for dubious is worried about.
So I would say there's nothing dubious about the portfolio, Kevin. It's well diversified. As you could see on the slide we created out of your portfolio, it's up 59.1% a year to date. Has a 1.28, and this is the bottom row on this slide. I'm referring to 59.1% is the average gain the portfolio has had year to date. And as Kevin Cook mentioned, we don't know how long you've held any of these positions. We don't know what is the individual weightages for any of these holdings in the portfolio. But just a straight average, it's up 59%. On a median basis, up 46.7%. The beta for the portfolio is 1.28 on an average basis, 1.23 on a median basis. The reason I'm mentioning the beta is that the question you raised was about what happens to this portfolio when things turn south, and everybody will be in a lot of pain when things do turn south. You will have your share of pain too. But given the quality of the picks, the level of diversification, I don't think that you will have any extraordinary pain relative to others. Would you agree with that, Kevin?
Yeah. So we haven't had a 5% pullback in over a year.
That's
so
right.
Hey, maybe we're due for a correction, and that will hurt everybody. I don't see it on the horizon anytime soon. But so let's look at some of the good specifics here. I like the concentration in technology, obviously. And when you look at individual companies, he's got a lot of semiconductors and what I call the arms dealers for semiconductors, the equipment makers. So you've got MKS, Lam. That's nice to see. But then you've got, you're mixed up here. Analog Devices is nice to see. They make stuff for cars and appliances, sort of the old line semiconductors, and then Apple's in there. So really nice mix here. And then when you talk about overall diversification, 3 auto sector, 1 in basic materials, 2 in construction, some finance, a couple of stocks from the oil patch. Only 1 healthcare stock, though. I got to thrash him for that, Sheraz. There should be more healthcare here. There's plenty of growth to find in healthcare. So, if you've got big profits in something, say in tech, which I don't mind being overweight in tech, but I think you also want to be at least market weight, if not overweight in healthcare.
Yeah, I think that's a good point. The diversification angle and the overweighting in technology is very, very obvious. It's a very growthy, tech-centric portfolio. Nothing wrong with it. This is one space in the market that's really been red hot this year. So no doubt Kevin's portfolio is doing very good. Apple is kind of like a standalone animal. It lives in its own universe. So 800 billion market cap, if I just took like a straight average of this portfolio, I've never been very good with math, but just eyeballing it, I think tech is about 80% of this portfolio, just by market cap. But that's because they have the 1,000-pound gorilla in there. But even if you take Apple out, it's still overweight technology. Now, it's possible that the Huntsman Corp holding the materials, he may have a large share of the overall size of the portfolio in that. So we don't know, but very heavily concentrated in tech. Tech has been on fire. If sentiment on tech shifts, even though the overall sentiment on the market remains the same, this portfolio will have a relatively extra pain. Just knowing where your exposure is and the risks you are taking, as long as you are taking them consciously and you are taking them with your eyes open, I think there's nothing wrong with taking extraordinary risks. It's not unusually risky. These are good-sized, blue-chippy, kind of good quality names. But there is an overexposure to tech. There is underexposure to discretionary, medical, you mentioned, finance. There is just this healthcare health insurer, Athene. So you have no brokers, you have no banks, you have no REITs, you have no insurers. That's a huge sector, so you're totally underexposed there. As long as that's conscience or conscious?
Yes.
That's a conscious decision. Then you should be fine.
Yeah, and it's about your time frame too. You know, you sort of have to model this and game it. Like, what if we get a 10 to 15% correction? Well, some of your growth-focused stocks are going to get hit 30%.
Absolutely.
They're going to take the wind out of them. But then you ask, would I still want to own this 6 to 12 months from now because I believe in the economic cycle and that industry cycle, and so I'm willing to withstand that. So that's what you have to know, is if you're willing to withstand a significant pullback. Other than that, you know, I mean, I don't see a 15% correction on the horizon in the next year.
Me neither.
Yeah, but if you did, then you would adjust accordingly.
Yeah, absolutely. And just stepping back from the specifics of the portfolio, I think it's, as I mentioned at the top, nothing dubious about it. It's well diversified, quality picks. The overall beta for the portfolio is about a little bit higher than the market, but it's hard to hit the exact S&P 500 beta with individual picks, particularly individual picks that are not mimicking the individual sector. So on the whole, Kevin, you've done a pretty good job.
Bravo, Kevin.
We still have top stock picks, but here are a few things you can expect to see coming up. Make sure to check out the 7 best stocks for the next 30 days weekly report, where Zacks experts reveal 7 stocks handpicked for immediate profit potential. Plus, keep an eye out for the newest special report, Profiting from Petroleum, 3 stocks to play oil's next move. It'll be posted on the Zacks Ultimate homepage in the coming weeks. And don't forget, the next Zacks Ultimate Strategy session will be posted mid-December. So start thinking of those submissions for the Zacks Mailbag and Portfolio Makeover segments.
What's up, everybody? Here with a top pick for you. I'm Dave Bartosiak, editor of Surprise Trader and Momentum Trader, and today talking about Ecopetrol, ticker EC. Now, there's 3 real big reasons why I think you should be looking at this stock. First, let's take a look at the oil chart here. So this is crude oil. You can see sort of a trend line to the downside, a downward trend channel that got broken. And when oil broke that downward trend line, that was a signal for everybody to jump on board. Just so happened that 50-day moving average has been providing plenty of support for crude oil recently. That's why you're seeing oil here in the mid-50s. Looks like it could start to run a little bit more. So that's the first part. The second part is my favorite chart, should be your favorite chart as well, the price consensus and EPS surprise chart on Zacks.com. Let's go ahead and dig into this. And here you can see there's been a trough in shares of Ecopetrol. So throughout 2013, 2014, 2015, lots of negativity as those oil prices were coming down, but it's since rounded out. The EPS story has turned around, and you're starting to see growth in EPS here on EC. That is a great bit of news here for shareholders, as this thing could be turning around. So you got oil moving in a positive direction, good for the oil E&Ps, plus you got the price consensus and EPS chart that's turning around. And then the third part, just good old-fashioned chart. You know I'm a chart guy. That's what I do in Momentum Trader every day. So let's break down technical analysis a little bit on here. Look at EC. You got this breakout that's occurred, right? After this top was put in throughout the course of the year, now just over the last few trading days, the stock is broken out to the upside. Couple that with the shaken money flow indicator there at the bottom of the screen, you could see the cross over the 0 line and the big breakout on that too. Not only does that confirm the breakout on EC on the other chart, but it also tells me that there's been a ton of institutional buying in this name. And if you're a retail guy, that is a huge benefit for you, that you know that there's some big boys that are on board with your trade. That's all I got for you here on my top pick. We'll send it on over to the rest of the crew and the rest of the Zacks Ultimate Strategy session.
I'm Brian Bolan, the aggressive growth stock strategist here at Zacks, and I'm here to give you my top stock pick for this Zacks strategy session. My pick is Electro Scientific Industries. The ticker is ESIO. And I know this stock is right now a Zacks rank number 3, or at least it is when we were filming this segment here. But it's very likely that this stock's Zacks rank will improve over the coming weeks. Recently, the company had a gigantic earnings report and crushed the estimate. They reported 39 cents when Wall Street was looking for 27 cents. And revenues were much stronger. They came in at 71 million when Wall Street was looking for 65 million. Now, this is great because we added this stock to Home Run Investor back before the earnings event. The stock was added on 10/25, October 25th, at about $16.90 per share. After the beat, the stock went up about 30% and was trading over 20 when I added it to Technology Innovators. Those are the two of the 3 portfolios that I manage, so it's in as many portfolios that I can put it in right now, and that's probably why it is my top pick. But the reason why it's my top pick is because guidance was so strong. The company is looking for next quarter to have EPS of between 48 cents to 60 cents per share when Wall Street was only expecting 2 cents. So that is a gigantic move. To back that up here, we have expectations for revenue moving from 44.5 million to 80 to 90 million. So basically double the amount of business is going to come in. Profitability is going to be well ahead of what they expected it. And the idea is that this stock is probably going to move to a $30 price target over the next couple months.
Well, that's this Zacks Ultimate Strategy session. We hope you found it interesting. Remember, send any feedback to mailbag@zacks.com. And if you have any questions about the Zacks Ultimate service, don't forget, you can always contact your account manager at ultimate@zacks.com or by calling 888-775-8348. International callers, 312-265-9309. And until next time, thanks again for watching. Thanks also to our technical crew. And as always, we look forward to sharing success with you for many years to come.